The US-based Silicon Valley Bank, SVB, faced stress and seizure of assets by regulators after incurring huge losses on its holdings of US bonds, following aggressive monetary tightening by the Federal Reserve. This sparked a wave of risk aversion, particularly for startups, globally. However, analysts believe that the Indian banking sector is unlikely to be a victim of any contagion effects. Indian banks have minimal exposure to SVB, and the financial sector is on a stronger footing following years of bad loan-related stress. The Reserve Bank of India, RBI, said in its December 2022 financial stability report that macro-level stress tests for credit risk showed that domestic banks would be able to comply with minimum capital requirements even under severe stress scenarios. The System-Level Capital-to-Risk-Weighted Assets Ratio, CRAR, in September 2023 is projected at 14.9%, 14%, and 13.1%, respectively, under baseline, medium, and severe stress scenarios. The minimum regulatory requirement for CRAR for scheduled commercial banks is 9%, and adding on a counter-cyclical buffer, the requirement is 11.50%. Banks have stepped up efforts to clean up asset quality, and gross NPAs were at a 7-year low of 5% as of September 2022. Profitability has improved as lending rates have climbed sharply in line with the RBI's rate hikes. Indian banks are large holders of government bonds as lenders are mandated to park a certain portion of their deposits in liquid assets such as sovereign debt. The statutory liquidity ratio, SLR, is currently at 18% of net demand and time liabilities, a proxy for deposits. Domestic government bond yields may have risen over the past year as the central bank has tightened policy, but the increase in the 10-year yield has been less than the policy rate hikes by the RBI. After climbing to a 3-year high of 7.62% in June 2022, the yield on the 10-year bond has retreated sharply and closed at 7.43% on Friday. Firm demand from long-term investors such as insurance companies has kept long-term bond yields anchored. Traders see domestic bonds benefiting from the SVB episode in the near term as the risk aversion sparked by the event has led to a flight to safe assets such as US bonds, causing their yields to drop sharply. A fall in US bond yields typically improves the appeal of higher-yielding fixed-income assets in emerging markets. From a longer-term perspective, Indian banks have become much more dexterous in handling interest rate risk stemming from bond exposure. Overall, the Indian banking sector is on a stronger footing, and the minimal exposure